Namaskaram. Welcome you all to today's CPE program on standards on auditing, SA 250, SA 550 and SA 570. More or less, it deals with auditing responsibility to consider law and regulations, and 550 is with regard to related parties and 570 is a going concern. I basically have one doubt, sir. I'll ask you that question first, then I'll go to this going concern concept. Basically, as a human, I'm just giving you my thought. As a human, we always consider ourselves as a growing person, and the same way. Hello,
it's breaking in between. Okay, go ahead, sir.
As a human, we always consider ourselves as a growing person, always where we wanted to live. Whereas our Purana says that we have to consider the date of birth is when it is ensured. The date of death is also ensured. So but the system should grow. That is what our culture has taught us. And in that context, I think today's session will give us more light on how we have to do as an auditor. And I welcome Sri Prasanna Varma sir to this program as a speaker. I welcome the audience who have already joined, participants of this program have already joined. Yeah, Mr. Prasanna Varma sir is a chartered accountant and he has got more than 30 years of experience, and he is a senior partner of his firm, and he heads the audit and assurance service practice in the firm with exposure to audit of companies in almost all industrial and service sectors. He also has extensive experience in areas of due diligence, valuation, and mergers and amalgamations, including drawing up of merger schemes. He has been involved as a technical member in selection panel of many companies for the recruitment of finance personnel, has presented papers on technical subjects in India and abroad. He has been actively involved in many social and also in industry and commerce forums at a leadership level. Thank you, sir. Thank you for accepting our invitation and participating in this program. I welcome you, sir. The forum is yours. You can take over the session, sir. Thank you, sir.
Hello, Shiva.
Sir.
Yeah, your presentation has come on. Thank you, Sundarajan, for the introduction. At the outset, I would like to thank. Am I audible?
Yes, sir.
You're audible, sir.
Yeah. At the outset, let me thank the SIRC officials and SIRC management for giving me the opportunity to make the presentation today on the 3 standards of auditing selected for discussion this evening. Those are SA 250, consideration of laws and regulations in audit of financial statements. 550 is related parties, and 570 is going concern. All the 3 standards are not new standards. SA 250 has been in operation since 1/4/2009, 550 since 2010. 570 going concern concept has always been there. It is one of the fundamental principles of accounting, going concern, consistency and account accrual. A standard was introduced, AAS 16 was introduced earlier, and it was renamed as 570 in bracket AAS 16. Later, it was AAS 16 that bracket was removed and it was renamed by SA 570. And then in 1/4/2017, a significant change was made in the standard as regards the reporting aspect. Main change was with regard to the reporting aspect of the going concern in the auditor's report. With this brief introduction, I think I will go to the standard one by one. First is SA 250, consideration of laws and regulations in audited financial statements. Not moving. Sorry. As I had mentioned earlier, the standard is applicable with from 1st/4/2009 and deals with the auditor's responsibility to consider laws and regulations in an audit of financial statements. And of course, this does not apply to other engagement in which the auditor is specifically engaged to test and report separately on compliance with specific laws and regulations. Now, effective laws and regulations to which an entity is subjected constitutes a legal and regulatory framework as far as the organization is concerned. As per the standard, these laws and regulations have been divided into two: one which may have a direct impact on the financial statements, and one which may not have any direct impact on the financial statements. Now, as far as laws and regulations which has a direct impact on the financial statements, it could be income tax law or any labor law or Gratuity Act or PF Act or any other act which has a straightaway impact on the financial statements as far as the law is concerned. And they could also be regulatory, other regulations, like in the case of banks, subject to RBI regulations. In the case of NBFCs, again RBI regulations. In the case of power sector companies, which is subject to SIRC regulations, those kind of regulations are also applicable, where it could have an impact on the financial statements of the straight away on the financial statements of the enterprise. So these are the laws and regulations which has a direct impact on the financial statements. And there are many other laws. And in fact, there are many other laws which does not have a direct impact on the financial statements concerned. There may be a Factories Act or Environment Act or some other act where if at all there is a violation, the financial impact would be very minimal. There could be a fine or penalty involved. The fine or penalty may be a very minimal amount, but if the fine or penalty has a significant effect on the financial statements, then that is a matter which the auditor has to be taken note of. And another aspect, as far as it does not have a material impact, is regarding some other laws like regulations like or laws like Environment Act or some RBI regulations. Environment Act, if there is a pollution control issue, it does not have any direct impact on the financial statements. But if there is an issue pursuant to NGT order or some other government order, if there is a closure of any factory, as we have seen in the case of the Tuticorin factory recently about 2 years back, then that could affect the going concern itself, or that could probably affect the going concern itself of the thing and has an indirect impact on the financial statement. Again, with respect to certain other regulations like RBI has certain regulations regarding net owned funds to be a minimum level for financial institutions or NBFCs and all that. If there is an erosion, the net owned funds in respect of any of these entities, there could be a issue that RBI may cancel the license or revoke the license, and thus it could have an impact on the going concern issue. So two kinds of laws: direct impact on the financial statements, very simple, which indirect impact on the financial statement, very unlikely that most of this thing may have impact on the financial statement. But these kind of laws, where there could be huge ramifications, are also there. And of course, it's a responsibility of the management to ensure that the entity's operations are conducted in accordance with the provisions of applicable laws and regulations. Now, we're coming to responsibility. As for the responsibility of the auditors are concerned, in relation to two different categories of laws and regulations, which we identified in the last one which has a direct impact on the financial statement, one which does not have a direct impact on the financial statement. As far as the first category, which has a direct impact on the financial statements, is concerned, the auditor's responsibility is to obtain sufficient and appropriate audit evidence about laws and regulations which has a direct impact on the financial statement. That means substantive audit procedures has to be conducted, and to ensure that there are no major impact on the financial statements as for the direct laws are concerned. As far as the indirect laws are concerned, which may have an impact on the finances, it is limited to indicating specified audit procedures to help identify any non-compliance with the other laws and regulations. So if you see the first listing, it is a substantive audit procedure where we have to obtain sufficient and appropriate audit evidence about the laws and regulations which has a direct impact. And with regard to second, which does not have a direct impact on the financial statements, our role is limited to identifying any non-compliance about other laws or regulations which may have a material impact on the financial statements. I would like to borrow that phrase from AS22, taxes on accounting for taxes. And there is a virtual certainty theory and reasonable certainty theory and all that. And here, if you see the first part, regarding the direct impact part, auditors have to virtually certain about the impact of the financial statements in case of any non-violence. And in case of the other loss and other, it should be a reasonable certainty that there could be an impact on the or there are no impact on the financial statements. And of course, auditor is not responsible for prevention of any non-compliance and cannot be expected to detect any non-compliance of any laws and regulations. That's very clear. This I have put in a chart for what I have said earlier, laws and regulations, which has a direct impact, which does not have a direct impact on the financial statements. So the duty of the auditor is to obtain sufficient and appropriate audit evidence in respect of the first one. And as far respect of the other laws and regulations which do not have any direct impact on the financial statements, duties of the auditor is limited to undertaking specific audit procedures to identify any non-compliance. Identify non-compliance and identify non-compliance which has a material impact on the financial statements. There could be many laws which are applicable to a company. There could be financial impact. There could be certain laws, the violation, there could be financial impact. There could be certain laws which does not have any financial impact. Auditor's duty is to identify only the material impact on the financial statements. Those violations, those non-compliance which has a material impact on the financial statements. And objectives of the audit generally are to perform appropriate audit procedures to identify non-compliance in case of non-compliance which has a material effect on the financial statements. This is the object of the audit, mainly whether in case of direct or indirect laws which are applicable, which has an impact on the financial statement. The auditor's duty is to perform appropriate audit procedures to identify any non-compliance which has a material effect on the financial statements. And if there is a non-compliance in the which has been noted by the auditor in the course of his audit, to respond appropriately to the non-compliance or suspected non-compliance. To respond appropriately has been very clearly mentioned in the standards down the line. What is the level of response that the auditor has to take? What are the steps the auditor has to take in case there is a non-compliance or suspected non-compliance identified during the course of such audit? And what is a non-compliance? I am not going to go through that. You all know what is a non-compliance. Any acts or omissions or commission, either intentional or unintentional, contrary to prevailing laws or regulations. And here in this aspect, auditors consideration of laws in respect of any laws or regulations which has a direct impact on the financial statements. Auditors required to obtain a general understanding of the legal and regulatory framework applicable to the entity and entity's compliance with the framework. So if the company is if the entity is a bank, then it is subject to RBI regulations. If the entity is some other sector, say power sector, it is subject to CERC regulations. Insurance companies are subject to insurance IRDA regulations. So what are the general regulatory framework which is applicable to the entity? There are certain laws which are directly applicable. Of course, income tax law is one of them, and any labor law will be applicable to the same. So auditor has to obtain a general understanding of the legal and regulatory framework applicable to the industry, and the entity's compliance of the legal and regulatory framework, auditor has to substantiate by way of audit procedures. That is the easier part of the audit. in respect of other laws and regulations, which does not have any direct impact as far as the financial statements are concerned, as we discussed earlier. The auditor's duty is to perform audit procedures to identify non-compliance with other laws and regulations which may have a material impact on the financial statements. Here, now, if you're talking about certain laws and regulations which does not have any direct impact on the financial statements, it's very difficult to identify because there may be 30, 40, 50 laws or rules or regulations which may be applicable to many of the entities. So it may be difficult for the auditors to identify what are the laws and regulations that are applicable to industry one, and secondly, are there any violation and whether the violation has any material impact. So the process what has been recommended by the standard is that one, inquiry with the management, and then inspection of any correspondence with the relevant licensing or regulatory authorities, and first, inquiring with the management has to comply with all the rules and regulations or anything come to the notice that there has been violation. Many a times you can also go to the audit committee minutes or board minutes or any correspondence with the licensing correspondence with say RBA, correspondence with any of the licensing authorities to identify any non-compliance with any of the other laws and rules. And of course, there could also be, you could also identify non-compliance through, analysis of the legal and professional charges and all that, where
Hello. Sir, you need to unmute yourself, sir. Welcome.
Unmuted. Sorry.
Yes, you're audible and visible, no problem, sir. Now we can continue, sir. The rights is with you. You can click on center of the screen and you can continue.
Yeah.
Thank you, sir.
And we were on inspection of correspondence with relevant licensing or regulatory authorities, analysis of any legal and professional charges, and no, there could be any. So probably that could be any charges which represent any law or legal issues and all that. So, and of course, to maintain professional skepticism throughout the audit to bring instance of non-compliance. And to obtain a written representation from the management, that's usual that there are no non-compliance which has an effect on the financial statements. Now here, the next procedure, the audit procedure to be followed when non-compliance is identified as suspected. In the course of a am I audible? Hello? Am I audible?
Yes, you're audible, but it's a little bit breaking. Let me just check.
Yeah.
Videos is network.
Yeah, network is like issue on the network, I think.
Just check with the Wi-Fi, sir. Is it proper? What we call the strength is good.
Yeah, Wi-Fi strength is good.
Okay, okay. You can continue this way, sir. Maybe after a while we'll turn on your camera. Maybe camera also might capture some bandwidth.
Yeah, camera may also be this one.
You stopped it right now. You can see there is no camera turned on. You can just continue this way, sir. And if there is any time your audio is gone, I'll let you know, sir. Sorry that the audio is gone. Hello.
And yeah, okay, sir. And in the course of the audit procedure, when non-compliance is identified or suspected by the auditor, the auditor needs to obtain an understanding of the nature. What is the nature of the violation which has come into his notice, and what are the circumstances of violation of the applicable law or applicable regulation, and there should be a step to inform. There should be necessary steps to be taken to assess its possible impact on the financial statements. This matter of once you come across any non-compliance, auditor is required to discuss this non-compliance with the management or those charged with governance, or in some cases, auditor needs to seek legal advice if the response from the management or those charged with the governance is not appropriate to form an opinion, audit opinion. And if sufficient audit information cannot be obtained, the auditor shall evaluate the effect of the auditor's opinion. Hello. And in case any non-compliance with any of the laws or regulations which has a material impact on the financial statements is identified, or there is any suspected non-compliance of financial statements, the auditor is required to report to those charged with governance, audit committee, as the matter may be. And if the auditor feels that the non-compliance is intentional on the part of the management and has a material effect on the financial statements, then it should be reported to those charged with governance. Those charged with governance is mostly audit committee or the board, as the case may be, as soon as practicable. That means normally the audit committee, auditors report to the audit committee only at the end of the audit, at the time of finalization, finalization of the accounts. But if it's intentional, if there is a major violation, a suspected non-compliance of the financial, any laws or regulations which has a material impact on the financial statements, the auditor is required to report to the audit committee or those charged with governance as soon as practical. That's what the standard says. So in case you come across a material deviation, it's better that you write to the audit committee chairman or inform the audit committee chairman or inform the chairman or managing director, as the case may be, that there is a material violation. And if in spite of that, if the auditor suspects that the management and if the board or if those charged with governance are involved in the non-compliance, then he shall report to the next higher level of authority. That means if there is audit committee, if the management is a CEO, CFO or all involved, and they are aware of the fact of the deviation, and then if it is reported, they find that it has to be reported, those charged with governance, the audit committee. In case auditor feels that those charged with governance, that the audit committee members are also aware of this violation, and then they shall report to the board of directors of the company. Now, in many other cases, especially in private company and all that, if no other higher authority exists, the board may be the same as a management because it may be a family name concern and all that. So reporting to the board will not have any much impact on the financial statements, and does not have any, may not have any impact as far as action is required. And in such cases, auditor shall, if required, seek a legal opinion as to whether what is the violation of the law and what could be the implication of the violation of the law. And the standard goes on to say that in case, auditor can also consider withdrawal from the engagement if it's practicable. If there's a major violation of the law, if it has significant impact on the financial statements, that the management is not willing to take any action as far as this matter is concerned, the auditor has to even consider withdrawing from the engagement. And in case withdrawal from the engagement is not possible, then evaluate the implication on the audit opinion. Auditor has to evaluate whether the audit opinion SS 700 need to be moved to SS 705 or 706 as the case may be. And as far as the auditor's report are concerned, if non-compliance has a material effect on the financial statement has not been appropriately addressed in the financial statements. Now, auditor comes across a non-violation, a violation of the laws, regulations, or non-compliance with any of the laws or regulations, which has a material impact on the financial statements. And in spite of the violation, there are the financial statements, it has not been properly dealt with in the financial statement. Dealt with in the financial statements is amending the financial statements, appropriate disclosure, what are fact is required under circumstances. Then auditor is required to give a qualified or adverse opinion as the case may be. And if the auditor is unable to obtain sufficient appropriate evidence to evaluate the effect of non-compliance. Now there is a non-compliance of a particular law. Auditor, as auditors, compliance of a law, in all cases, auditors cannot sit on judgment whether it has been complied or with. Auditors cannot sit on judgment whether there has been any violation of any of the laws or regulation or non-compliance, because legal interpretations may be involved in that. So in spite of all this, if the matter is referred to a legal counsel and the auditor is not able to obtain sufficient appropriate evidence to evaluate the effect on the financial statement. There may be violations, which does not have an effect on the financial statements. But auditor's duty is to evaluate the effect of the non-compliance in the financial statements. If that is not available for any reason and auditors are not able to conclude what is the effect of this non-compliance on the financial statements, auditors should consider either a qualified opinion, and if it's pervasive, probably a disclaimer of opinion also. And if the non-compliance is because of limitations imposed by circumstances rather than by the management, auditor shall evaluate the effect of the auditor opinion, whether SS 705 has to be, or even attention, because in certain circumstances, even management cannot, there are certain circumstances where management may not be able to act because of certain outside conditions and all that. In such circumstances, whether how to report is judgmental, and auditors have to take a call whether how to report appropriately. this is one important aspect as far as any non-compliance or law or regulations conduct. If the auditor is required under any of the law or regulations under which the audit is conducted to report to external authorities like say RBI or any government authorities and all that, that has to be the auditor has to determine whether he has the responsibility to report to the outside parties and the entity. And in this case, auditor has to be very sure that there has been a compliance with the law and which has a material impact on the financial statements before reporting to the external authorities. Ideally, auditor should discuss with the management that there is a violation of the law or non-compliance of the particular law. It has impact on the financial statements. After having taken all these steps, and in spite of that, there is a non-compliance of financial thing, the auditor has to report to the external authorities as required under any of the regulations. And of course, documentations to identify suspected non-compliance and result of disciplinary with management. So in case there is a non-compliance with any of the legal requirement, any of the laws or regulations, auditor is required to these results of the discussion, what are the variations which has been noted, what are the non-compliance which has been noted, what is the impact on the financial statements. This has to be brought to the attention to the management and those charged with governance and other parties outside the entity if required. So this is documentation which is required as per the SA 250. That's as far as SA 250 is concerned. Now we'll go to the more important standard of SA 550, related parties. And here the standard deals with auditor's responsibility regarding related party transactions when performing audit of financial statements. As I was mentioning in the opening remark, this standard is effective from 1st April 2010. And the standard goes on to say that there are nature of related party transactions. There could be two types of related party transactions which the auditor could come across in the course of our audit. One which carries normal risk of material misstatement of financial statements. That is, you have a transaction with a related party which is at arm's length, like any other transaction with outside parties and all that, and it does not have any issues as far as disclosures or anything is concerned, then that carries only a normal risk of material misstatement. As in any other case, any transaction will have a risk of material misstatement of the financial statements, and this type of transaction, which is at arm's length, carries only the normal risk of material misstatement as far as the financial statements are concerned. But there are certain other transactions with the second line type of transaction which carry significant risk of material misstatement. Here, in this case, some of the illustrations which has been given by the standard is complex range of relationship and structures and resultant complexity in transaction. There are large number of subsidiaries, large number of related party transactions, related parties, large number of joint ventures, and there's a maze of transaction with between all these entities and all that, which cannot be properly identified. It carries significant risk of material misstatements. As you are aware, recently there has been a big corporate failure in BFSI sector, and in the report which has come out after the SFIO study or forensic audit, it mentions that the particular company had about 175 subsidiaries and about 66 joint ventures and associates, through which a maze of transactions was routed through, and it finally ended up in round tripping of transactions, evergreening of loans, masking of end use of funds, and all kinds of not so conducive level of transactions was identified in that. So these type of transactions, which has a very large number of transactions, which is very complex as far as the relationship of the related party is concerned, as far as the amount is concerned, and complexity of the transaction carries significant risk. Inadequate or ineffective information system to identify. So obviously, in these cases of transaction, there is no proper system to identify what are the nature of the transaction, where there is no proper trail to identify this transaction. There could also be inadequate or ineffective system to identify related parties also. What are the related parties and what are the transactions involved, and whether the transactions are of arm's length, how do you justify that? So this also carries significant risk of material mistakes. And finally, third, this thing is, of course, the transactions are not at arm's length. If the transactions are not at arm's length, it carries significant risk as far as financial statements are concerned. Now, as far as related party transactions are concerned, the responsibility of the auditor is to first to ensure that the financial statements achieves a true and fair presentation as a result of the transaction with the, in spite of the transaction with the related parties, it does not mislead the presentation of the financial statements in any manner. That is the first responsibility of the auditor. And again, probably there could be chances that fraud, one or more fraud could be present in the transaction with related parties. That's also the responsibility of the auditor. And of course, the third responsibility is planning and performing the audit with professional skepticism, which we all know. It's a part of all the standards. Here we have come to the definitions which are been given in the related parties transaction. Related parties arm's length transaction. Of course, we all know what is an arm's length transaction. Transaction conducted between a willing buyer and willing seller, and as an independent of each other. So that is an arm's length transaction. Related party has been defined under AS 18. There is a corresponding definition in Ind AS 24. Companies Act, there is a definition in section 276, allied with 188. Yes, SEBI LODR also has a related party definition and transaction procedure which has been recommended or mandated. Now, if you see, there are certain differences in the definition of related party as far as AS 18 and Ind AS 24 is slightly larger in base as far as related party transactions is concerned. Companies Act section 276 right with 188, it prescribes certain procedures to be adopted as far as what are the related parties and what are the procedures to be adopted as far as related party transactions concerned. There are certain limits which has been prescribed in the Companies Act, and 10% of the turnover, 100 crores, and whichever is less, and all that, for the purpose of identifying what are the transactions which need the shareholders' approval, which at what level the approval has to be taken. SEBI LODR, if you see, has certain different levels which has been prescribed in Regulation 23 of the SEBI LODR. So the procedures, definition, there have been some changes here and there. This is a subject matter for discussion by itself. I'm not going to all these details and all that. Now, as a part of the audit procedure, the auditor's first duty is to have a risk assessment procedure. And as a part of the risk assessment procedure, the first duty the auditor has to do is inquire with the management, with the related parties. What are the related parties the management has entered into? Have they identified the related parties properly? What are the type of transactions which that related party transaction? What is the nature of the relation with such parties, and all that has to be inquired with the management. And the second and more important aspects of the related auditor's risk assessment procedures includes identification of parties, the management controls which has been put in place for identification of any new related party or any transaction with the related party, and what is the process put in place for approving this transaction, for disclosing this transaction, for accounting this transaction. That is a very important part of the auditor's duty and all that. Many companies have, of course, listed companies have, you have the audit committee of the board, which approves all the related party transaction initially in omnibus basis and all that. And many of the companies have put a code of ethics in place, which has been, which is applicable to the directors, which is applicable to employees and all that. There is independent set of management who looks into all this kind of transaction with the employees and all these kinds of related party transactions. So there is a set of procedures which has been put forward by many companies. In spite of that, these kind of deviations happen in many companies because of the audit. But in case of private companies, which most of us are auditing, what the general understanding is that you have to essentially depend on the management of the private company to identify related parties and nature relations and transactions. Because it's very difficult. They may not have this kind of elaborate procedure as far as like any other public listed company or any other large companies and all that. And there could be, see, we have encountered with the management regarding the related parties and the transactions and all that. And there could be a possibility, or during the course of your audit, there could be any indication that there are other related parties and transactions with them, which has not been identified by the management or which has been identified by the management and not disclosed to the auditors. This is a very dangerous thing as far as the risk is concerned. And many, this thing could be bank. One of the source where such identification is possible is through bank. As you are aware, many of the related party transactions, what happens in a practical way is that the related party or the company, which is a related party, would have taken a loan from the bank, for which the parent company would have given guaranteed for that loan, or they would have given the collateral for that loan to the bank. And so bank is one source where we could identify if there are any related party transaction which has not been properly identified, if not identified. And of course, legal and if they go through the legal records of the company or legal correspondence, there could be something which come up. Minutes of the means to shareholders could be this one. Any other party, in the course of the audit, because the auditor should be alert to the fact that there could be any other related party or any other transaction which has not been identified by the management or disclosed to the auditor. And once you identify a related party transaction in the course of audit, either the information is given by the management or you identify separately in the course of audit. The relevant information about entities related party has to be shared with the engagement team to consider the risk of material. The engagement teams to be informed that these are related parties and you have to look into the arm's length transaction or whatever this. And of course, auditor to design and perform further audit procedures. Auditors should enter substantive procedures to ensure that transactions with the related parties which has been identified are at arm's length. But if in the course of the audit, auditor comes across any related party transaction which has not been previously identified by the manager or which has not been disclosed by the management to him, then the first requirement is to communicate to the engagement team regarding the new RPT or related party and transactions identified, and then request the management to identify all transactions with the concerned related party and inquire with the management how they fail to identify such a related parties and transactions. And once you identify a related party and the transaction in the course of the audit which has not been disclosed by the management to the auditor, it is a duty of the auditor to, or due to the engagement team to be alert as to transactions which has hitherto not been identified with the related party being there. So I have identified in the course of audit, I have identified a related party A Limited with whom I have a transaction of say 1 crore. It will be quite possible that there could be other transaction with the same related party A Limited. So that has to be identified in the course of audit. Auditor should remain alert for any other transaction with those parties. And the second and more important aspect is that since there has been a failure in the system, auditor should be allowed to the fact that there could be other related parties itself which has not been identified by the management or which has not been disclosed to the auditor. And if non-disclosure by the management of the auditor is intentional for some reason, then it is indicative of a material fraud. It could be a material fraud, and auditor has to evaluate the implication from the auditor's report. And this is regarding the, see, there are various types of transactions. Normally in a manufacturing company and trading company, there will be transactions of purchase, sales, manufacture, or all kinds of those things with related parties and non-related parties. But risk, significant risk is attached normally when there is a transaction with a related party, which is outside the normal course of business. Outside the normal course of business means it could be purchase of asset, sale of asset, which normally happens in the normal transaction. But with a related party, there could be a transaction for the purchase of asset or sale of assets or lease of assets, and these transactions carries a significant amount of risk, because it's very difficult to identify and difficult to conclude on the arm's length of this kind of transaction. For example, I will tell you that suppose there is a lease, large parcel of land which is owned by this company and which has been leased out to a related party for, say, a very long period, 30 years or 50 years for a very nominal lease. So probably it is an alienation of the asset. Substance of a form, it is an alienation of the asset. We discuss with the management will say that no, this party, they are going to put up a factory there and they will supply raw materials. So we are ensuring raw material supply in the future and all that. That probably could be the reason also. But then to concretize on what is the intention of the management and to finally conclude that there is no arm's length violation is a very difficult process in these type of transactions. Now, in another one of the report, in another one of the corporate failure report from the public domain, there was a transaction which was entered into by this company with a third party for purchase of land. And then later course of time, this land purchase was transferred to a subsidiary company. The MOU was transferred to a related another company, associate company. 90% of the shares of the associate company was held by related parties, and 10% of the shares were held by this company, which had entered into the agreement with the other party at the initial stage. And the entire consideration for this new company for purchase of the land was provided by the parent company. This company has at a very low interest rate, and very nominal interest rate. So this kind of transaction, and this has been identified as one of the non-compliance with the related party transactions and all that laws and regulations in the report. So these kind of transactions happen very quite often, and this transactions carry significant amount of risk as far as the audit is concerned. So in case of such transactions with entities which are not in the normal course of business, it is the duty of the auditor to consider fraudulent financial reporting or concealment of misappropriation of assets. That could be the reason that assets have been alienated in this case in some form or the other. And then you have to ask the management what are the further explanation in the terms of the transaction which has been entered to, whether it has been consistent with the management explanation. These transactions have been properly accounted for. This has been properly disclosed, properly authorized, properly approved. So this area is one of the most significant area as far as related party transactions are concerned. Significant amount of risk is attached to such a transaction, and auditors has to be very alert for any violation or any deviation from the normal policy as far as this goes. And of course, on assertions that these above related party transactions were conducted at arm's length, auditor has to obtain the sufficient audit evidence as how this has been justified. And this kind of transaction is very difficult to justify also, to justify the arm's length also, because there will be some other conditions applied to this, as I mentioned in the case of a lease, because the lease has been given for a long period of 30 years or 50 years. And 50 years lease rentals, what you get will be only 50% of the total value of the land, which is present value of the land, which has been alienated. In what manner will you justify that? It is very difficult to justify all standard. Management's contention is that the related party transaction, the party is going to put up a manufacturing unit, and they will be supplying raw materials to us, and we are that way, our supply of raw materials for the next 30 years or 40 years is assured. But these kinds of transactions, it's very difficult to substantiate arm's length transaction. So auditor, there is significant risk attached to these kind of transactions. Auditor has to be very careful as far as such transactions are concerned. Now, as far as the audit report is concerned, SS 700 is concerned, it is a duty of the auditor to identify whatever related party has been identified and transactions are identified. These are properly accounted for and it is properly disclosed as required in the applicable financial reporting framework, note or by whatever means. And the most importantly, whether the effect of the related party transactions has any cause that the financial statements could be misleading. In many cases, as I was mentioning, the substance or form of the transaction could be different from what is on paper. So, if in any case, if there is any doubt on this front, it is the auditor's duty to make sure that the financial statements has not been misled in any manner. Of course, written representation for management that all this thing has been disclosed and they are appropriately accounted for. And now, auditor's duty also includes communication with those charged with governance, matters arising in the course of audit in connection with the entities related parties. In the course of audit, if the auditor comes across any related parties or any transactions with related parties which has not been hitherto reported by the management or which has not been disclosed by the management, any new development coming during the course of the audit has to be reported to those charged with governance at the time of audit. And documentations, of course, shall include in the audit documentation the name of the identifier, related party, and nature of the relationship as far as related party transactions are concerned. Now, as I have not put a slide here, but as I was mentioning in a recent case of failure of a large corporate, and from the report available in the public domain, there are some of the matters which has been identified as related to the related parties, which has had a material impact as far as the financial statements are concerned. One of the main aspect which has been identified is that there is a related party transaction which has been, approved by the board. A policy for related party transaction has been approved by the board. And during the 4-5 years in between, there have been frequent revision of the board policy as regards, many of the aspects which has been put in the initial board policy has been changed. What, that intention was to broad base a financial transaction with these related parties and also funnel more transactions into the financial related party transaction, related parties. Some of the, so the frequent, changes in the related party transaction, whether it could have triggered a professional skepticism in the minds of the auditor. I'm not sitting on judgment on the auditor's role, or I'm not sitting on judgment on the management or anybody like that. But the fact remains that there are frequent changes in the related party transaction policy, which has been put up by the board and approved by the board over a period of very short period. And this probably is one of the reasons that auditors could have, or any other matter, auditors should have gone into this transaction, why there is a frequent change in related party policy. And what are the new transactions which has been, there is a policy setup, there is a change in the policy, certain parameters in the policy has been changed. Suppose that there are change in the parameters, what are the new transactions which has come into the policy, why, within the policy, change policy, how it can be at arm's length and all that is, it's a doubtful matter which could have been triggered professional skepticism or whatever this. Again, one of the matters which has been reported is that in respect of related party transactions, the arm's length was to be identified and reported and by the statutory auditors of the company. That's the initial requirement of the policy. Later, it was shifted from statutory auditors to internal auditors. So how far the internal auditors are, no, internal auditors normally extension of the management principles and all that, whereas statutory auditors is entirely independent function. So shifting it from the statutory auditors to internal auditors was another significant change that was made by the board, and that could probably have been another indication of violation of related party transactions and all that. The third was that there was a, in case of many transactions, there was a policy to have an independent valuer to assess what is the value of the transaction, as what the value of the assets, which has been concluded as per the, or is to be concluded as per the related with the related parties. Here, the independent initial policy was the independent valuer. Later, the policy was changed to make it an independent valuer who has been empaneled with the company. Empaneled independent valuer, how independent he is was another subject matter of debate. So these kind of changes in the related party policy also has could have been, I mean, the auditor should be alert to these kind of changes of related party transactions and related party policies, and that could probably, I mean, we can come out with some kind of a issue if there is anything. Related party, of course, is a very hello, 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 can you hear me? Hello?
Yes, you're audible. Please tell me, sir.
Yeah, okay. So related party SA 550 is one of the important aspects of audit. So as far as private limited companies, which most of us are auditing, it is concerned, the related parties, as I mentioned earlier, we have to essentially depend on the management information as per who are the related parties and what are the transactions involved in related parties. But at the time of audit also, you have to be alert to many cases where related parties, there could be other related parties, and there could be other transactions with these related parties and all that. But by and large, essentially it is the management who we have to rely on the management for identification of related parties as far as private concern and concern. And the third and most important standard is the going concern. Of course, as you are aware, going concern is one of the fundamental principles of preparation of financial statements. Going concern, consistency, approval, and assessing of the entity's ability to continue as a going concern is essentially the management responsibility. And auditor's responsibility is to evaluate whether the management's assessment of the going concern is appropriate. And you all know, we all know, SA 700 report, auditor's report, it clearly brings out these facts. First, in the management responsibility para, where going concern has been mentioned, and again in the auditor's responsibility para, where auditors are required to assess, evaluate the management's assessment, has been clearly brought out. As far as SA 570 is concerned, originally it is titled as IAS 16. Subsequently, it was revised as SA 570, IAS 16, then changed to SA 570, removed the IAS 16 portion, and finally, in what form it now appears, has been revised and brought into effect with effect from 1st April 2017. There is a significant change which has been brought out in 2017. what happened is that this has been brought out in line with ISA 570, International Standards on Auditing 570. The International Accounting and Auditing Standards Board, based on the feedback they got from various stakeholders or authorities and all that, came to the conclusion that earlier SA 570 the reporting requirement was to report any going concern under emphasis of matter para. But it was felt by the International Accounting Standards Board, Auditing Standards Board, that reporting under emphasis of matter para did not evoke the kind of attention that is required in respect of such an important matter as going concern. So what has been done is that it has been removed from the purview of emphasis of matter para, and a separate para, material uncertainty relating to going concern, has been brought out and to be reported above emphasis of matter paragraph. That's a very, very striking heading. So it cannot escape the attention of any of the stakeholders. That was a significant change made in 1470 in line with ISA 570. And this is a background why it has been changed, because International Accounting and Auditing Standards Board felt that reporting this going concern matter in emphasis of matter paragraph did not have the capacity to attract attention of the stakeholders. Of course, going concern is a fundamental accounting assumption as per AS1. It's also basis of the normal basis of preparation of financial statements in the AS1 and framework. And what going concern assumption implies, we all know what it implies. Entity is a going concern, will continue its operation for the future, foreseeable future. And the most important thing is assets and liabilities are recorded on the basis that the entity will be able to realize its assets and discharge its liabilities. That is the most important part. The moment the entity is not able to realize its assets and discharge its liability, it becomes a going concern issue. And assessment of going concern, of course, is a management responsibility. It's primarily responsibility of the management to assess that. It involves making a judgment at a particular point of time. That's that at the year end, the financial statements are being prepared, or any other in between time, and also it can be. And these are the considerations which are normally taken into account when preparing the assessment of going concern. Expected time in future when an event or condition occurs, size and complexity of the entity, nature and condition of business. These are 4 or 5 matters which drive the assumption of whether the going concern assessment is complete or what. As far as auditors are concerned, auditors' duty, responsibility is to assess the appropriateness of the going concern assumption of the management. So management has made an assumption of the going concern, and it concludes that it's a going concern. No, it is the duty of the auditors to assess the appropriateness of the going concern assumption which has been concluded by the management. And based on this assessment, auditors has to conclude whether the going concern assumption is appropriate, one, and whether a material uncertainty exists about the entity's ability to continue as a going concern. So first, this thing is to assess the appropriateness of the going concern. Second, then whether the going concern is appropriate and whether there's a material uncertainty, if it's appropriate, whether there's a material uncertainty as far as the going concern is concerned. And finally, report based on the above conclusion. How to assess a going concern, we all know. We are all chartered accountants. I don't think it requires much this one. But generally, these are the parameters which are being considered. There are financial, operating, other parameters. Financial parameter, adverse key financial ratios, debt equity ratio or current ratio, those kind of adverse ratios could indicate that there is a problem of going concern. Substantial operating losses, the negative operating cash flows, continuous cash flows, negative cash flows is also a matter of concern as far as going concern is concerned. Significant deterioration in the value of CGUs, arrears of dividend, preferential dividend being declared and it has not been distributed, breach of loan covenants, and there is a default of any loan, and that could also be indication that there's a going concern problem and all that. Excessive reliance on short-term borrowings to finance long-term assets. That's also an indication that companies are not able to bring in funds on a long-term basis to fund its assets. And also, as you are aware, even the statutory matters, various statutory matters which has been statutory liabilities. If there are a defaultance to payment of statutory liabilities, if there is a delay in the payment of statutory liabilities, these could be indications that there is a going concern problem which is prevalent in the company. And as far as the operating aspects are concerned, management intends to liquidate the entity. Management has finally concluded that there is no point in continuing, has decided to liquidate the entity. Of course, then there is no going concern. Key management person leaving the company, loss of a major market, principal suppliers could loss of principal suppliers, unresolved labor unrest, emergence of a highly successful competitor. These are some of the indications where going concern could be affected. And third one is non-compliance with any of the legal requirements of regulatory proceedings. There could be regulatory proceedings which could be a problem. Changes in government policy expected to adversely affect the entity. That also could be a problem coming in future. For example, in case of automotive industries, now the EV, if suppose the government comes out with a policy that in the next 2 years or 3 years, it is going to, all these cars are going to be replaced by EVs, or 50% of the cars are going to be EVs. There could be a problem as far as these entities are concerned. So changes in government policy, which it may affect now, it may affect in the future also, which will have an impact on the going concern ability of the and uninsured or underinsured customers, of course, you all know that. And once you have identified, management has identified the going concern problem, and auditors are in agreement with the going concern problem, then what are the mitigation plans? Auditors has to inquire with the management, what are the mitigation plans which has been taken up by the management. So some of the events and conditions and the corresponding mitigation plans normally taken up by the management are mentioned here. Liquidity position or debt default, of course, the option could be disposing of assets, rescheduling of any loan repayment, further infusion of equity, those kind of things. Principal supply loss, availability of suitable alternate supply of alternate sources of supply. Government policy where the product diversification is possible. Negative operating cash flows, again, funding requirement will be required, and what are the plans for funding? So these are the mitigation plans which the management will have, and auditors will have to take note of the mitigation plan. And in case of small companies, private companies, and most of the companies, these kind of adverse effect would have a much larger impact as far as the going concern is concerned. Of course, large entities, to some extent, they can survive even if there are some small challenges. Now that management has identified a going concern problem, management has identified or taken steps to mitigate the plans. Now, after this thing, auditors' duty is to evaluate the management's assessment of the going concern issue. Now, for the assessment, what the standard says that the period of assessment has to be a minimum of 12 months from the reporting date. So the going concern assessment of the management has to be in place and for the period of 12 months, a minimum of 1 year from the reporting date. So 31st March 2022, you have identified a problem as far as going concern is concerned. Up to 2023 at least, a minimum up to 2023 at least, what is the plans of the management to keep the company afloat? What are the action taken by the management to keep the company afloat? Now, if the management is not willing to prepare for future projections or willing to prepare the future action plan only for 3 months periods or only for 6 months period, auditors, it is a duty of the auditors to insist that a minimum of 12 months period plan has to be put in place for the management, and auditor has to look into that. If you look at the illustrations given in the guidance note and implementation of SFISMD, there are certain illustrations which have been given. Even if it's less than 12 months also, auditors can take that into consideration. Suppose that audit of 31st March 2020 is taking place, and it will be in July or August when you sign the financial. By that time, if substantial funds has come to the company, there is a substantial improvement of the cash flows of the company, and under such conditions, probably the auditors can take a view that take comfort that 12 months assessment may not be required, but because by that time company has substantial turnaround, but normal course the period of assessment should be a minimum of 12 months. So you sign a balance sheet of 31st March 22, and before 31st March 23 the company goes down, then it's a big problem as far as the auditors are concerned. And then in case if there is an issue that could occur beyond the normal period of assessment, as declared change in government policy, as I was saying, it's supposed by 2024, 50% of the cars will be EV cars in India or something like that. Then the assessment has to be extended to that period. How the management has considered that extended period for the purpose of assessing or concluding the going concern. So minimum of 12 months assessment is required. And if there is an indication that there could be a future event which could affect the going concern, the assessment has to be extended to the future period also, that is 2 years or 3 years probably. And as far as small entities are concerned, it has a big problem. It has, so you have to discuss with the order and management what are the how he is able to bring in funds and all that. In many cases, we know that because of lack of collateral securities and other things, owners may not be able to fund the enterprise, fund the additional loan requirements, or bring in money. So as far as other smaller industries are concerned, it is a discussion of the management how to bring in additional funds or what are the steps taken by the management for this purpose. And as far as audit procedure is concerned, you know how to assess, all this management assumption. Additional audit procedures, latest interim financial results, as I was mentioning, suppose with the audit is happening in August or after 31st March 22 and 22 August. Latest interim financial statements, if we can be prepared and there is a significant turnaround in the results, then yes, that could be considered. Cash flow and profit forecast, what the management has prepared. Borrowing facilities, potential breach of a loan covenants. If there is a potential breach of loan covenants, suppose there is a external commercial borrowing coming up of for repayment by 30th September, and the management does not have management is in deep financial difficulty and does not have the fund to fund the repayment of the external commercial borrowing. Either it has to be restructured. So what are the steps taken by the management to restructure this loan, or what are the other additional funding requirements which the management has tied up for repayment of this loan? Then, of course, what are the steps taken by the management, the directors and relevant committee? Minutes of the meetings of the directors and relevant committees, which has been forward for, will give a comfort as far as the auditors are concerned. And relevant any other relevant subsequent events. Now, mostly on a practical level, what happens in the case of any of the going concern issue which come up is that management will prepare a forecast as far as the future cash flows are concerned, future profitability is concerned. Here it is a duty of the auditor to evaluate how the future cash flows are being prepared, how the forecast has been prepared, what are the basis of preparing the forecast, what are the underlying assumptions which has gone into the preparation of the forecast. And one thing is that you have to compare the, if you see the forecast in many cases, if you see the forecast, suppose 31st March 2022, the turnover will be say 100 crores and there could be a loss of say 20 crores. And if the management forecast will say 22-23, there will be 200 crores turnover and probably a break even. And the next year will be 400 crores turnover with a profit of 40 crores and all that. Such this thing, you're very skeptical about such forecast which I may prepare with management, because this is one area. Identify a going concern problem is easy, but to conclude on the appropriateness of the going concern assumption of the management is a difficult task, mainly because of these kind of projections and all that. Unless it's a one-off issue. If it's a one-off issue, as and you have a loss coming up, or you have a loan coming up for repayment, and you're not able to fund the loan repayment, and the management comes up with the funds, either from some other borrowing or from the management's own funds, they are able to do that. Okay, fine. That issue is closed. But in a case of other companies where it is dependent on the future cash flows and all that, to conclude that going concern appropriateness is a very difficult task as far as the auditors is concerned. So auditors has to be very careful in coming to the conclusion as far as the going concern aspects are concerned. And finally, in many cases, as we know, companies which are subsidiaries of large corporates, members of a large corporate group, or subsidiaries of very, very large companies or subsidiaries of foreign companies. One of the methods is to get a written confirmation from the parent company that we will be supporting the subsidiary company or joint venture company to tide over the difficulty. We will have continued presence in the company, and we will take care of the funding requirements of the company. So this is one of the aspects which it has been there. There is a format given in the standard, 570 illustration standard, and what is the type of letter you have to get from the company. So in many cases, in some cases at least, we know, okay, getting a letter is one thing, and it is easier part of it. But if the other company, if the associate company or the group itself or the parent company is itself in difficulty, then auditors has to look into that aspect also. So in many cases, suppose in case of a foreign company, and the Indian company is an associate of the foreign company, and Indian company is a subsidiary of the foreign company. What happens is the foreign company will give a letter saying that we are willing to support the Indian company. Many cases, the foreign company may not be a listed entity. Their financial statements may not be available in public domain for us to review. So in that case, transaction, most of the subsidiaries of foreign companies are incorporated in India, or business, most of the business, 80-90% of the business that the Indian company does is with the foreign company. So if there are any indications based on this transaction with the subsidiary company and the foreign company, like reduction in the volume of the business, or suppose sundry debtors, large amount of debtors are outstanding, and the amount of relations of sundry debtors vis-a-vis the transaction levels are very low, then that could be an indication that the foreign company itself is in problem. So that is one of the areas which auditors has to be very careful. Getting a written confirmation is one thing, but the ability of the other concern to support the entity to continue as a going concern has to be looked into very carefully. Now, in some cases, and at least in one case, what we have noted is that there is an Indian company is doing very well. There is a profit, but almost 60-70% of the transactions are with associate company in Europe or some other country. I'm not mentioning the country or all. Now, the foreign company, associate company, is in some kind of difficulty. So the sales, what they do is they do the value addition as for the sales material supplied by the Indian company and sell in the local market there. Now that company is not doing well. And what is happening in the Indian company? The Indian company has built up debtors, huge amount of debtors as due from the foreign company. And the amount coming in from the foreign company is in trickles. So, Indian company has substantial borrowing from banks, which are supporting the operations of the Indian company and all that. So per se, from the balance sheet of the Indian company, Indian company is a comfortable going concern. There are no issues as far as the Indian company is concerned. But since substantial part of the debtors are outstanding as receivable from the foreign company, and foreign company is not doing well, which can be assessed from the inflow of sundry debtors to the Indian company, there could be an underlying going concern issue for the Indian company. So that also the auditor has to take into consideration. Balance sheet as the Indian company shows good profit and whatever this thing, ratios are all good and all that. But this is one aspect which probably may have a significant impact on the going concern of the Indian company, even if it's doing well. And then we come to the auditor's conclusion on reporting. So we have identified going concern problem. Management has assessed their ability to continue as a going concern. Auditors have reviewed and what are the management assessment of the going concern, management conclusion of the going concern. Based on conclusion arrived at by the auditors, as we saw in the other side, auditor's duty is to report on the conclusion. So material, meaning of material uncertainty linked to events which may have significant doubt on the entity's ability to concern as a going concern. We know what is that. And the magnitude of the potential impact would be here, and likelihood of its occurrence. If the likelihood of its occurrence is removed, then there is no material uncertainty. But if the likelihood of its occurrence, suppose there is a huge tax demand, and the company is say 100 crore company, and over a period of time there is a GST demand or something like 80 crores or something, and it's a subject matter of the court proceedings and all that. There could be this thing that it can go against the company. There could be chances that it can be in favor of the company. So if it's in favor, chances are that it can be in favor of the company, the likelihood of its impact is very minimal. So as we see in the case of contingent liability also, AS29, if the chances are remote, then there is no material uncertainty. Auditors can conclude that there is no material uncertainty. So once we have concluded that there is a going concern issue, there is a material uncertainty issue. Now, finally, we come to the reporting part. The reporting, there are various scenarios which has been given in the standard, and one of the scenario is that one going concern basis is inappropriate. Company is no longer a going concern. In such a and financial statements of management has assessed that the company is a going concern, and on that basis, the financial statements have been prepared on a going concern basis. In such a case, auditors have no option but to give an adverse opinion, does not show a true and fair view of the state of affairs of the company. Now, management accept that it is not a going concern, and the financial statements are prepared on the other basis, accounting, that is a liquidation basis of accounting. That means the historical cost convention and all that is not applicable. Finally, what I'm going to release from the assets and what I'm going to settle, what are my net assets position, that is a liquidation basis of accounting. And if that method of accounting is entirely different framework, and that basis of accounting has been adopted, and the same is found to be acceptable to the auditors. Okay, auditors agree that there is not a going concern and separate method of accounting, proper disclosure has been given in the financial statement. The auditors have to give an unmodified opinion, but attention has to be given in the emphasis of matter paragraph regarding the state of affairs, and the management will be giving a note regarding the going concern aspects and why the accounts have been prepared on the liquidation method, and for that attention has to be given by the auditors in the emphasis of matter. The second scenario, what could be envisaged here, what has been envisaged in the standard, is that going concern basis is appropriate, but there is a material uncertainty which exists. The current liabilities is exceeding the current assets by say 50 crores or something like that. There is an erosion in net asset position of the company. Frequent last 2-3 years there have been cash losses in the company and all that. So these 2-3 conditions are there. So there is a material uncertainty as for the financial statements of the going concern aspect is concerned. But management has taken steps for mitigating all this, bringing in funds or whatever this thing. We saw what are the mitigation plans with the auditors, the management has taken. And based on the litigation plan, the going concern is considered to be appropriate. There is a ministerial understanding. And the management gives a detailed disclosure in the financial statements regarding the material uncertainty, what are the conditions as on that date, and how the management plans to mitigate the going concern issue. The note detailed disclosures given in the financial statement. Then auditor's duty is to give an unmodified opinion, but a separate section, as I was mentioning initially, a separate section in the audit report above going concern, material uncertainty related to going concern. That is a heading to be given, and it has to be drawn attention. It's an unmodified opinion. We'll come to them, how to report that. It is in the coming slides. Now, this is what adequate disclosure. What is adequate disclosure? That is one of the aspects of standards. Here, if you see the adequate disclosure means the principal events or condition which has an effect on the going concern. As I was mentioning, say current liabilities exceed current assets by so much, this thing, and the net asset has eroded significantly. There have been cash losses and all that. That are the principal events or conditions which has affected the going concern. The management plans to deal with these events and conditions has to be given on the note. So note will give a detailed management explanation as to how they are bringing in additional funds, or they are restructuring the loans or whatever to mitigate the going concern issue. What are the identified the principal events or conditions has been identified, how the management plans to mitigate that. That is part of the note. Management has to say that there is material uncertainty relating to these events or conditions. And these conditions, events or conditions cause significant amount out of the entity's ability to continue as a going concern has to be brought out in the note. And the last one, if you see, it may be unable to realize its assets and discharge its liabilities in the normal course of business. This statement, this is adequate disclosure. Now, on a practical level, in many companies which we have dealt with, the last line, it may be unable to, management is okay to give a note regarding the principal events or conditions which has created going concern issue. What are the mitigation plans? That material uncertainty related to the 1, 2, 3, and probably 4 also management is willing to give a note. But many a times we have found that the last line, it may be unable to realize its assets and discharge its liabilities in the normal course of business has to be stated in the notes to accounts. But that many of the managements are reluctant to state that. They said that once you state that, then demise of the company will be hastened. They have a feeling with that. Yes, that's also partly true. So in many cases, we have noted that many companies have given this, but this line is missing from the note where they have given. Honestly. Yes, in my personal opinion, if you give all the other 4 aspects which has been given an adequate note of this thing, because what are the conditions of going concern issue and management's plans, and there is a material uncertainty and all that. I think that is, personally I feel that is enough instead of lying, but yes, standard says that this line item has to be included in the adequate disclosure. Many times, many notes which I have gone through, this line item is not there. But that's a call the management has to take, and that's a call the auditor has to take, very satisfied with the disclosure given by the management. Now,
Hello, sir.
hello?
Yes, tell me, sir.
Can you hear me, no?
Yes, you can. Yes, we can hear you.
So the separate section, we were mentioning about separate section, again, material uncertainty regarding this one. So there is a note to be given by the management. So there is a going concern issue. There is a material uncertainty and adequate disclosure. What is adequate disclosure? We just discussed now. Now, as far as auditors are concerned, if this disclosure is satisfactory, then auditor has to draw attention in his report under material uncertainty. And in that report, he has to draw attention to the relevant note in the financial statement. He draw attention to note number so on the financial statement, wherein as per which the current liabilities exceed the current assets by say 100 crores and all that. This may cost, these events or conditions indicate that the material uncertainty is there. Auditors has to mention that there is a material uncertainty which may cast doubt on the entity's ability to continue as a going concern. And finally, auditors has to mention that his report is not modified in respect of the above. So the complete disclosure is made by the management in the note in the prescribed format, and auditors draw attention to that note and mention that there is a material uncertainty as far as the state of affairs is concerned, and which may cast a doubt on the entity's ability to continue as a going concern. This fact has been clearly brought out in the auditor's report as a separate one, and of course, it's not modified. Now, the third scenario what has been contemplated in the standard is that going concern is appropriate. There is a material uncertainty which exists, but management is not willing to give any disclosure in the financial statement. In such a case, auditors has no option but to qualify the report, or if the auditor feels that the effect of the material uncertainty is pervasive on the financial statement, it may probably have to qualify, give an adverse opinion also. So management has assessed the going concern and concluded that it is appropriate. Auditors have also agreed with the management, but there is a material uncertainty which exists, right? But the only fact is that there is no adequate disclosure in the financial statement. In such a case, auditor are supposed to qualify the report that there is uncertainty in the financial statement which has not been brought out by the management. This is the basis of this thing, that in such a case, a qualified adverse opinion section has to be given the thing and state that material uncertainty exists that may cast significant doubt on the ability of the continue as a going concern. And finally state that the qualification is that the financial statements do not adequately disclose this matter. Financial statements in this thing has to be fully understandable to the users of the financial statement. And if this fact has not been brought out, that it is implied that the financial statements is not full and complete, that to be understood by the end users or stakeholders. That is the reason why Institute says that it has to be qualified. Standard says that it has to be qualified. It's a similar line with ISA also. The fourth scenario which has come is that auditors now conclude that there is a going concern issue. Management also agrees that there is a going concern issue, but management is not willing to make any assessment as to how what are the steps they are going to take regarding the what are mitigation of the issues which have come up. So either the management is not willing to make any assessment as to the future of the company, or management is not willing to extend this assessment to minimum of 12 months period, or such extended period as we discussed earlier. So management says, no, next 6 months, this is my plan. After 6 months, I have not done any plan. I don't know what is going to happen. But I am confident that it's going to, that is a normal management explanation. But in such cases, the auditor does not have any information. The auditor is not satisfied with the information. So that is one aspect of it, extending in 12 months. Now, there could be a condition that after 24 months or within a period of 24 months, there could be another condition which could, say, like we were mentioning earlier about EV vehicles or something like that, or any major another government change of law. So what could be the condition? You should extend to that basis. The management is not able to make any assessment, make any mitigation plan, or extend this assessment to the time period which is required. Auditor will have no option but to qualify or to disclaim that we are, we don't know what will be the effect of this thing. We are not able to express an opinion regarding the going concern issue. This is a decision tree for audit opinion. You see, I've made a this thing. The first thing is, has the management made or extended the assessment of going concern? And that, to satisfactory level, satisfactory time frame, 12 months or extended period, as we discussed earlier. If the management has not made or extended the assessment of the going concern, there is qualified or disclaimed opinion. If the management has made an assessment, then if is the going concern assumption appropriate, is the next test. Not appropriate, then financial statements has to be drawn up in the other method of accounting, not in the regular going concern basis. If the financial statements has not been prepared on the going concern basis, adverse opinion does not say true and fair view. If the financial statements has been prepared on liquidation basis, and then unmodified opinion, emphasis on matter paragraph. Now, as far as going, then does a material uncertainty on the basis of the assumption appropriate? Then is there a material uncertainty as far as this going concern is concerned? If there is no material uncertainty, no comment in the auditor's report, of course. And if there is a material uncertainty, the proper disclosures have been made in the financial statements. If no disclosures are made in the financial statements, qualified or adverse opinion. Or if proper disclosures are made in the financial statements, of course, unmodified opinion, a separate paragraph has to be given on the auditor's report. Now, as you are aware, last 2 years back, SA 701 key audit matters have become applicable, and auditors should include a reference to material uncertainty. Now, material uncertainty related to going concern is a key audit matter as per SA 701. So, in a condition, in a case where SA 701 key audit matters has to be given, then material uncertainty related to going concern has to be included in the key audit matter. But what happens is we have already done in a separate para as material uncertainty above emphasis on matter paragraph separately reported as a modified report or unmodified report. In such a case, the reporting format in standard 701 says that in addition to the matter described in material uncertainty related to going concern section. So material uncertainty related to going concern is a key audit matter, but since we are reported separately as a separate paragraph, we are mentioning here that in addition to the matter described in material uncertainty related to going concern, these are the other key audit matters. So we communicated in our report, just to avoid duplication of the report. And of course, assessing this SA7, as I was mentioning initially, in reporting SA 700, management responsibility is there, which has been in assessing the going concern, and auditor's responsibility is also given in the report format, and I am not going to that. These are the earlier changes, and the main change as far as the new SA 757 is concerned is regarding the last para, where a separate section related to going concern has been brought in and taken away from emphasis of matter para. Now, see, these are the reporting format given in the standards. Material uncertainty and disclosure is adequate. There is a material uncertainty as far as going concern is concerned, and the proper disclosures are made. Then separate para, material uncertainty related to the going concern, where we draw attention. You are drawing attention to the set note in the financial statements, which indicates the company has incurred a net loss of so much more, and during the year end, and also update the company's current liabilities exceed the current assets by so much amount. These events or conditions indicate that a material uncertainty exists, and that may cause significant doubt on the company's ability to continue as a going concern. Our opinion is not modified. So we are drawing attention to the note, which describes all the conditions and what are the mitigation plans of the company and management and all that. And we are stating in our report that a material uncertainty exists in our report. And finally, opinion is not modified. The second condition is that when there is a material financial, there is a material uncertainty exists, and the financial statement is materially stated due to inadequate disclosure. but it is not pervasive. It is only, not the fact is not disclosed in the financial statement. Then you have to give a qualified opinion, and the basis of qualified opinion, in your opinion, to the best of information according to a special given, except for the incomplete disclosure of the information referred to in the basis of qualified section of the opinion. So that is a qualification, except for the incomplete disclosure of the information referred to in the basis of qualified opinion. And in the basis of qualified opinion, you mentioned the fact that company's financial, what was the base, what are the condition which is persisting as on the date of the financial statements, that the company's finances are remain expired and amount outstanding are payable. Company is unable to conclude. This is one of the this one. Company is unable to conclude negotiations or cost replacing the financing. So this situation indicates that a material uncertainty exists. That same wordings have been brought, and the financial statements do not adequately disclose this matter. The financial statements adequately not disclosing the fact that uncertainty exists, proper note being not given in the manner which has been prescribed in the SA, which we discussed some time back, then it's a matter of qualified opinion, and auditor has to qualify the opinion. And in case the material uncertainty exists and the financial statements is materially misstated and pervasive due to inadequate response, then the auditors have to say that it is does not show a true and fair view. Here, if you say the words used for the basis of a dose opinion and the basis of a qualified opinion are the same, it has to state that there is a material uncertainty which exists. The facts may be different, but material uncertainty exists and which has been not disclosed. But if it's pervasive and it may have an impact on the entire financial this thing, if the auditor feels that it is pervasive, then instead of qualified opinion, auditors have to give a adverse opinion. So as I was mentioning, in case of going concern, the part regarding identification of going concern issue is easier, but to conclude that the appropriateness of the going concern is a difficult task. That is the most important part as far as the auditors are concerned. As far as the documentation is concerned, you have to document what are the things and how the appropriateness has been proved by the management. Management's conclusion is appropriate. For that, elaborate documentation will be required, especially when we rely on future forecast and provisions, projections and all that, because it's very difficult to justify the projections if it's in a very abnormal manner and all that. So that is one area which auditors has to look into the fact. And even on the other cases where the management says that we are bringing in large amounts of funds, 50 crores, 100 crores here and there and all that. Now, what are the sources? As the management are tied up with the funds properly, management has the resources to bring the funds properly. These things has to be properly identified. So, as far as the auditor is concerned, the conclusion of the going concern, appropriateness of the going concern is the most important fact as far as audit is concerned. Thank you.
Thank you so much, sir. So we have some questions that has come, 3 or 4 questions. I'll share my screen. Is my screen visible, sir? So these are the questions. So we'll take it. Do you want me to read, or else you can read it out, sir?
Yeah, okay. If the company have not disclosed the related party and schedule, whether the auditor has to report the same in the audit report on the opinion now, if it's AS 18 under the applicable accounting standards, the financial transaction with any related party transaction has to be disclosed in the notes to accounts. So if there is no disclosure of the financial transaction, there is a violation of AS 18, and if there's a significant violation of AS 18, yes, auditors may have to consider this in the auditor's report. whether it is qualified or it cannot this thing, because there is a para that financial statements are prepared in accordance with the accounting standards prescribed. There is a violation as far as the report is concerned. As per the financial statements account, that it has not been disclosed, but it does not affect the true and fair view of the financial statement. So probably a qualification there, except to the extent of so much and all that, could be considered by the auditors. It's a violation of standard, yes. Now, if the transactions with related parties are not at arm's length transaction, whether auditors have to report on the company side. Now, if the transactions with the related parties are not at arm's length, the main issue is that whether it affects the financial statements, in what manner. If the auditor comes to the conclusion that it has affected the financial statement, it misleads the financial statements, or it does not show, financial statement does not show a true and fair view, then auditor has to consider reporting on the company side. But just because it's not at arm's length, auditors, if it does not have any material impact on the financial statements, then auditor may not report the fact. So if you see the all the related party transfer, the material variations are there as far as the arm's length transactions are concerned, and it is not justified, then yes, probably it could be misleading the financial statement. In such a concern, auditors have to qualify the report. If private company is no, I don't think auditors has any role in this thing, unless it's strictly because private limited company, as far as is concerned, payment to remuneration of the directors is substantial. What is the auditors we need to consider? No, it's too, because if it's too much, too high, and it distorts the thing and all that, auditors will have consider whether it's arm's length. But generally, in a private company, there is no restriction on payment of remuneration to directors and all. So I don't think auditors will be affected by any. What is it? SFI only gives clear guidance on how to assess on the proper disclosure. No, as per Indian accounting standards, yes, the liquidation method of accounting is no, it has not been fully. I think IFRS permits liquidation method of accounting and what method of accounting is. But if there is no going concern, the concern is not going concern at all, then there is no point in considering a historical consequence or not. So it has to be moved into a fair value model or realizable value model, and then financial statements has to be prepared. Complete shift to the historical cost concern has to be made.
Those were the questions that came up over the session, sir. And if there is any, we'll send it to you or mail it or we receive after the feedback. Thank you so much for your excellent session, sir, and taking up all the queries. We, on behalf of SIRC Chairman and Secretary in the absence, thank you so much for your time, sir. Knowledge sharing governance.
Thank you, sir.
So can we wind up the session, sir?
Yeah.
Sure. Thank you so much, sir. We will look forward for much more sessions like this.